Hello and welcome to the next edition of the Capital Stewards Podcast. IRAs, 401ks, the TSP, ROTHs, it's a super of acronyms. And one of the most common questions I hear from clients and from friends is which retirement accounts should I be using and when? So in this episode, I'm going to dive into what the main retirement account types are and how to use them to accumulate wealth when you're saving for retirement, and then also how to use them when you're decumulating wealth or spending your assets in retirement. So, if you have questions about which retirement accounts to use, you're not alone, and this is the episode for you. The first thing I want to start with is an overarching framework that might help you think about which retirement accounts to use when, even if you get some of the specifics wrong as we dive into the details. I think frameworks are just easy. They're easy ways for us to remember things and think about stuff in 3 months, 6 months, 2 years when we're making decisions about retirement saving and investing. So the framework is really simple. The most important thing for you to remember today is that we want to think about making decisions about retirement accounts through a tax lens. And that means that we want to pay taxes when the tax rate is the lowest. There are no tax-free retirement accounts. Another common myth is that Roth IRAs are always better than 401ks or vice versa. If your tax rate stays the same, there's actually no difference between investing in a Roth and a traditional deferred tax retirement account. So the big question, the framework that we're going to answer and that I want you to remember as we talk about this concept is that I want to pay taxes when my taxes are the lowest. So the big question we have to answer is whether we want to pay taxes now because our tax rate now is low, or should we defer those taxes and pay taxes down the road when our tax rate might be lower? So understanding your relative tax position and your marginal tax rate, and hear me, your marginal tax rate is not the same thing as the average tax rate or your tax rate from last year's tax return. Your marginal tax rate is the tax rate that you would pay on the next dollar of income that you earn or the next dollar of income that you take on your tax return. So understanding your relative tax position and your marginal tax rate is actually the most important thing to think about when you're deciding whether you should invest through an IRA, through a Roth IRA, or any other kind of retirement account, in my opinion. And the problem, of course, is that very few people actually know what their marginal tax rate is today, much less what it might be in 10 years. So there's a good reason right there to talk to an advisor or to your CPA. Make sure you understand what your current and your future tax situation is going to be, and that'll help you make smarter decisions about which types of retirement accounts to use and when. All right, so if you can remember that opening framework, we want to pay taxes when the tax rate is lowest, then you'll be on your way. So let's dive into some of the specific retirement account types and whether they fall into the sort of pay taxes now bucket or the pay taxes later bucket. All retirement and investment accounts fall into 3 categories, and I like to think of them as buckets. You'll see this in the illustration that we're going to pop up on the screen, and we'll refer back to this as we kind of walk through this episode. If you're listening on the podcast, you can find a link to the buckets chart in the show notes and check it out there. The first bucket of retirement account types is tax-deferred accounts. In these accounts, you get a tax deduction today for contributions up to a certain threshold generally, and you pay taxes on those distributions in retirement. Examples of tax-deferred accounts include traditional 401ks, traditional IRAs for private sector employees. If you work for a government or for a nonprofit, you might have the TSP, a 403B plan, or a 457 plan. All of those are tax-deferred accounts. So if I think my tax rate is high today and it will be lower down the road in retirement, I want to use tax-deferred accounts first. The second bucket of accounts is Roth accounts. These can include traditional Roth IRAs and the Roth side of your 401k or another retirement type plan that is at your employer. In Roth accounts, you pay taxes on the income that you use to make contributions today, but then the growth and the future distributions down the road are tax-free. So if you expect your tax rate to go up over time, then Roth accounts should be your primary focus because you're going to pay taxes today at the lower rate, and then you're not going to owe any taxes down the road. The third bucket is a standard taxable savings account, and these are often forgotten. Contributions to retirement accounts are limited. You can only put so much money in a 401k, in an IRA, in a Roth. And so eventually you might need to save more than that and you contribute to a taxable account. In taxable accounts, you pay taxes on the income when you earn it, and since it's not inside of a retirement account, you also pay taxes as you go along as you realize gains income. However, those taxes are at lower capital gains and hopefully preferred dividend rates because hopefully you're holding things longer than a year and you're not doing too much trading. So you do get some preferential tax treatment because you already pay taxes on that income, but it's not all shielded from taxes as it grows like it would be if it was in a retirement account. I talk about employer sponsored plans there, but if you're a small business owner or if you're an independent contractor or a 1099 worker, you may not have a formal employer sponsored plan, but there are still options available for you on both the tax deferred side of the ledger, like solo 401ks, SEP or simple IRAs, and on the Roth side of the equation as well. So the same rules apply. The specific account types just might be slightly different. They might come with different rules, and there are some differences around which types of account you should use, both to accomplish your personal savings objectives and also to accomplish the retirement savings objectives that you're trying to push into your business. So you might have objectives for your employees and for others, and there are limitations around exactly who you're going to offer accounts to and how much you can save as a business owner. So you want to get some advice if you're a business owner. But the bottom line is the principles from this still apply. There are tax deferred accounts, there are Roth accounts, and then there's taxable brokerage accounts. You can think about it the same way, just different account types, and you want to get some advice there. There are some resources on our website that specifically apply to business owners, and so you can check those things out as well. So now that we have an idea of what we're working with, let's talk about which accounts we should use when we're building wealth, and then down the road we'll move to decumulation, or which accounts we should spend from first. So when you're saving for retirement, in the early to middle part of your career, you're likely in a lower tax bracket than you will be at the middle or at the end of your career when earnings are the highest. The common objection to that, by the way, that I hear is, oh, Brian, tax rates, they've gone down over time. And that's true. The top federal tax rate has gone down. If you look at a chart from like the 1930s or 40s through the 50s, 60s onto today, the top federal tax rate has gone down. But you as an individual likely earn more money later in your career than you earned at the beginning of your career. So your tax rate probably goes up as you move through your career. So in that early part of your career, you're likely in a lower tax bracket because your income is lower than you will be at the middle of your career or at the end of your career. So the logical answer then is to prioritize investing in Roth accounts like we talked about. Well, maybe, right? And there's an exception in both scenarios, but generally, regardless of your stage of life and income, the absolute first place, so your first priority for saving for retirement is probably in a 401k or any other kind of account that provides an employer match. So if your employer matches your savings dollar for dollar or even 50 cents on the dollar, that's effectively 100% or a 50% return to you overnight. And there are vesting rules, other things like that you might need to consider. But generally speaking, no tax planning benefit is ever going to overcome those matching benefits. So the very first place you should always save for retirement is in any employer plan that has a match. If you can receive those matching dollars in Roth contributions, then that's even better. But make sure that you get the match, even if you're contributing to a traditional 401k plan early in your career. So after you get all of your employer's match, then the earlier you are in your career, the more likely that it's important for you to focus on Roth contributions. So get the employer match, then focus on Roth style contributions. You might be able to elect Roth contributions to your 401k. A lot of people don't realize that, but your 401k might enable you to make after-tax Roth contributions right there. No more complicated than that. There are no income limits on Roth K or Roth 401k contributions either, so that's really, really important, especially for high income earners. So anybody can contribute. If you can't contribute to an employer-sponsored Roth plan and your taxable income is below the threshold to contribute to a Roth IRA, which in 2024, there's a phase-out that starts at $146,000 of taxable income if you're single or $230,000 of taxable income if you're married. So if your income is below those thresholds, then you can contribute directly to a Roth IRA. So that would be the next place to go is employer-sponsored Roth contributions. If you can't do that, then contribute directly to a Roth IRA. The challenge with direct Roth IRA contributions is A, the income limits. You might earn too much money to contribute directly. And B, you can only contribute $7,000 in 2024 to a Roth if you're under age 55. And if you're over age 55, you only get an extra $1,000. So it's not that much money. So the logical question then is, well, what do I do if I want to save more than $7,000 or if my income is too high in a Roth? And the third priority then, so get the employer match, direct contributions to a Roth either through a Roth IRA or through an employer-sponsored plan. The third thing to go do after you do those two things is called a backdoor Roth or a backdoor Roth IRA contribution. You may have also heard this described as sort of a mega backdoor Roth conversion or a contribution. There's all kinds of words that go in there, but anything that's in that category, that's what we're talking about here. The strategy here is simply you're making after-tax contributions to your 401k plan, and then you're going to roll all of those over to a Roth. This process can be complicated, and there's a lot of rules to consider, and some 401k plans may not even let you do it, so until you leave your job or something like that. So there's an entire post on our blog about Roth conversions and backdoor contributions and things like that, questions to ask. There's a lot of pitfalls. So if you're thinking about backdoor Roth contributions, I'd suggest working with an advisor, working with your tax professional, making sure you execute that strategy correctly. But that would be the next place to go in our pecking order here. Early to mid-career, when your tax rate is lower, you want to start with matching contributions, make sure you get those things. Look to Roth contributions either directly into a Roth IRA or into a Roth 401k if that's an option. And then the third place in the pecking order would be those indirect contributions through backdoor Roth conversions. As we move up into the middle or later stages of our career, typically our income and tax bracket goes up. Again, you can see the buckets here. It's important to note in this conversation too, I'm assuming that this will happen. There are careers where your income might be more stable over the course of your career, and that's okay. And if that's the case, this might not apply directly from you. The right strategy might be more balanced between Roth contributions and tax-deferred contributions over the course of your career. It might not be sort of leaning in on one side and leaning in on the other side. But if your income is rising, then your taxes go up, and you should prioritize contributions to traditional deferred retirement accounts like 401ks, traditional IRAs, the TSP, 457 plans, etc., as we move into the middle and end of our careers. When you're making those kinds of contributions to traditional tax-deferred accounts later in your career, you're likely getting the tax deduction for your contributions at the highest rate possible, so you're getting the most benefit for making those tax-deferred contributions. Now, later in your career, you might also have enough income to save beyond the $23,000 that you can get a tax deduction for. So you shouldn't stop saving via retirement accounts just because you hit that limit. You can continue to add money to Roth accounts and other types of accounts, but you want to prioritize, if your income is really high, those tax-deferred accounts. So later in your career, just to kind of summarize, the priority should be tax-deferred accounts like IRAs and your 401k, and then perhaps making additional contributions to Roth accounts or to standard brokerage accounts as your income goes up. But, and there's a big caveat here, I often find that mid to sort of late career professionals have been piling the maximum into their tax-deferred 401ks for years, and now their 401ks or their IRAs represent the vast majority of their assets. I call this maxing out your taxes by maxing out your 401k contributions. This is not a good idea, but we can't go back to when we were 30 and magically recharacterize all those things as Roths. That's not a strategy that we can do. So let's talk about what you can do going forward if you have a large IRA or 401k tax-deferred account sort of balance out there relative to all your other assets. If that's the case for you, it's important to look at long-term tax projections to determine whether to keep funding a tax-deferred account in the end of your career, like a 401k, or whether you should maybe start making Roth contributions even though you aren't getting the tax deduction for doing that. If all of your assets when you get to retirement are tax deferred, your tax bill down the road, especially when you're hit your 70s and you're required to take those required minimum taxable distributions annually, that tax bill might be really high, even higher than it is today. So tax planning is super important. It might make sense, even though your taxable income has gone up over time, for you to balance out your existing tax-deferred holdings with Roth contributions, like I said, even though you're in a high tax bracket. So the answer might vary a little bit if you've got a really big balance of if you've got a bunch of dollars in your 401k or in your IRA. Our initial framework still holds, though. You want to pay taxes when the rate is the lowest. Long-term tax planning can be super helpful in retirement account contribution decision-making, and you see this in particular as you get to the middle and the end of your career. It's one place where one size definitely doesn't fit everybody. And understanding what your current tax rate is today, again, what that marginal tax rate is, what it's going to be in retirement, that becomes vitally important for reducing your taxes over the long term. All right, so let's talk about decumulation or spending in retirement. I think this will add some clarity for why it's hard to make it sort of a one-size-fits-all plan for folks later in their career. Again, the goal is to lower our tax rate over the long term. In my experience, that generally means having consistency in tax rates in retirement. Generally, if you were just to run sort of a time value of money analysis and take into account all the tax impact, you would find that letting tax-deferred assets like your 401k or your IRA continue to grow in retirement would produce really good results. That tax deferral is really powerful when you're compounding it over time. The problem is that the government starts to force those taxable distributions when you're in your 70s, and that's a graded scale depending on exactly how old you are. Those are called required minimum distributions. You may have heard about those other places. And so if we let our tax-deferred assets grow and grow and grow, and then in the few years that we're required to take required minimum distributions, those distributions will be so large that they require us to pay really high marginal tax rates. That's the problem I was talking about a few minutes ago with folks that are just piling money into a 401k. So again, this is typical. Your situation may differ, but taxable income tends to go down slightly early in retirement. So in those years, early in retirement, we want to spend roughly evenly from our tax-deferred IRA or our 401k and our taxable investments. It might also make sense to do Roth conversions even if our tax rate really goes down from your 401k or IRA to get that money out of those tax-deferred accounts when our tax rate will be lower. Again, we pay taxes at the lowest rate possible, right? Pay taxes at the lowest rate possible. That's what I want you to remember. So in those early years, you might actually do things that drive your tax rate up marginally, but as retirement goes on, your retirement income is going to increase. The taxable retirement income is going to increase from all those required minimum distributions. So as you move through retirement, you want to rely more on your Roth savings and less on tax-deferred accounts. You start with those RMDs, you have to take those, but then you don't want to increase your tax bill any more than you have to. So later in retirement, you start with the RMD because you have to, with those required minimum distributions. But then you might want to fund additional spending either through your taxable brokerage account or through a Roth. Lastly, when we talk about Roth assets, we really want to hold on to those things for as long as possible. The taxes are paid every year. The taxes are paid, right? Every single year of tax-free compounding drives more after-tax wealth for you. So you want to spend the sort of the tax-deferred assets in your standard taxable brokerage accounts first. Hold on to those Roth assets as long as possible. Roth assets are also good assets to leave to your family. Taxes are already paid. So just again, when we think about the decumulation phase, to summarize it all up, generally, the right approach is a balanced spending from your tax-deferred accounts like your IRA or 401k and a taxable brokerage account, and then letting that Roth sort of sit there, continue to grow and grow and grow, and then either supplementing your income later in life from that Roth or just letting it grow and passing it down. That's generally the right approach for decumulation. Again, there are exceptions to every rule, and your situation might differ from our ideal lifetime saver based on what your career path looked like, what your earnings are, what your assets are. Did you sell a business? Did you have a lot of cash flow come in one year? Real estate. There's all kinds of things that can sort of make this sort of like what the typical, ideal averages might look like. There's all kinds of things that might make those things not apply to you. So it's important to work with a financial planner, work with your tax professionals, understand your current and future tax rates, and save and spend accordingly. Regardless, our fundamental framework that we talked about at the beginning, you want to pay taxes when the tax rate is the lowest, is going to apply. That those time periods just might change based on your specific situation. So regardless of your situation, I hope this gives you a basic framework for reducing your taxes over the long term and thinking about how to contribute to the different kinds of retirement accounts, when you might want to use them, and then also how you might use them in retirement. You can use contributions and eventually withdrawals from retirement accounts to manage your tax rate over time and reduce taxes over your lifetime. And that is the goal of tax planning and frankly, really good financial planning as well. So if you have questions about applying any of this to your situation, I'm happy to discuss further anytime. There's a link in the show notes to schedule time on my calendar. There's also more resources on our website that'll dive into these scenarios in more depth, so you can check those out as well. And I look forward to meeting you down the road and talking to you again on the next episode of the Capital Stewards Podcast.